All right, let's talk about something that has totally reshaped the world of investing for millions of people. It's a financial tool that you've almost certainly heard of, and today we're going to break down exactly what it is. So, to get a sense of just how massive this thing is, let's start with a question. What single financial tool has gotten so popular that it now holds almost $15 trillion in assets all around the world? And get this, in 2024 alone, that same tool pulled in a record-breaking $1.5 trillion in new money. I mean, that's more than the entire market for them was worth just a decade ago. The growth has been nothing short of explosive. So what is this thing? Well, you probably guessed it. It's the exchange-traded fund, or as we all know it, the ETF. It's a true financial phenomenon, and right now we're going to unpack what it is, how it works, and why it matters so much. Okay, so at its very core, the idea is actually beautifully simple. Just think of an ETF as a shopping basket. Instead of going out and buying one apple, then one orange, then one banana, you just buy a prepackaged basket that's already filled with hundreds, sometimes thousands of different fruits. That whole basket then gets one price, and you can buy and sell it on the stock market all day, just like a single share of, say, Tesla or Amazon. So where do ETFs fit into the bigger picture? Well, they kind of carve out their own unique sweet spot. See, a mutual fund, it's also a basket of stocks, but you can only buy or sell it once a day at whatever the closing price is. An individual stock? Sure, you can trade it all day, but you have zero diversification. An ETF gives you the best of both worlds, the diversification of a mutual fund and the all-day trading of a stock. And on top of that, they're usually way cheaper and more tax-friendly. And that killer combination of features, well, it's what has fueled this absolutely incredible growth. I mean, look at this timeline. The whole journey began back in 1993 with the OG of ETFs, the SBDR S&P 500, ticker symbol SPY. By 2014, the market was already at a huge $2.9 trillion. But then, fast forward just 10 more years to today, and boom, it's multiplied by 5 to almost $15 trillion. Just staggering. Okay, so that's the what. But what about the how? How are these baskets actually put together, and how is the price kept fair? It's time to peek inside the engine room. It all comes down to this really clever process called creation and redemption. Now, it sounds complicated, I know, but the basic idea is pretty simple. You have these huge financial institutions called authorized participants, or APs, who are kind of like the middlemen. What they do is go out and buy up all the actual stocks in an index, like all 500 stocks in the S&P 500. Then they deliver that whole basket to the ETF provider like Vanguard or iShares. In return, they get a giant block of brand new ETF shares, which they then turn around and sell to investors like you and me on the open market. And this right here, this is the secret sauce. That whole creation and redemption process is what keeps everything honest. If the price of the ETF on the stock market ever drifts away from the real-time value of the stocks inside it, these APs can jump in, they can either create more shares or redeem old ones to make a tiny, risk-free profit on the difference. And that constant activity, called arbitrage, is what keeps the ETF's price locked super tight to its real value. It's a really elegant system. And this brings us to two terms you're going to hear all the time: NAV and market price. The net asset value, or NAV, is the official value. It's the calculated price of all the assets in the basket, usually tallied up once at the end of the day. The market price, on the other hand, is what you actually pay for the ETF on an exchange, and it's bouncing around all day based on what people are willing to buy and sell it for. The magic of that arbitrage we just talked about is that it forces the market price to stay incredibly close to the NAV. Okay, so we've got a handle on what they are and how they work. They sound pretty great, right? But like any financial tool, they have some amazing benefits and, yeah, a few potential downsides. So let's get a nice balanced look at the pros and cons. Let's start with the good stuff, and man, there's a lot of it. The pros are exactly why ETFs have taken over the world. With one single click, you get instant diversification. The costs are usually rock bottom, way lower than old school mutual funds. You can buy or sell them in a split second, anytime the market's open. Their structure is built to be really tax efficient. And, maybe best of all, you know exactly what you own, because most of them publish their entire list of holdings every single day. Total transparency. But, of course, we've got to look at the other side of the coin. Since you trade them like stocks, you might have to pay brokerage fees, which can add up if you're buying and selling all the time. Sometimes there's a small tracking error, which just means the fund's performance isn't a perfect one-to-one match with its index. And while most ETFs are simple, there are some really exotic ones out there, leveraged inverse funds that are super complex and can be incredibly risky. And believe it or not, you can even over-diversify by owning too many similar funds, which just ends up watering down your potential returns. So let's pull it all together. When you look at the big picture, why have these things become so fundamental to how we build portfolios today? Who's actually using them and what for? The short answer? Pretty much everyone. Everyday investors and their financial advisors use them to build simple, cheap, long-term retirement plans. Giant institutions, like massive pension funds, use them to get quick exposure to a specific market without having to buy all the individual stocks. Even high-powered active fund managers use them as building blocks inside their own complicated strategies. That incredible versatility is a huge part of their appeal.
And if you want to see just how mainstream these have become, just look at these numbers. These are the titans of the ETF world. The Vanguard Total Stock Market ETF, VTI, has nearly $2 trillion in it by itself. And the big S&P 500 trackers, VO, IVV, and the original SPY, are all giants, each managing hundreds of billions. We're not talking about niche products here. These are the absolute bedrock of millions and millions of portfolios.
You know, this quote here really gets to the core of how you should think about ETFs. The biggest takeaway is to never treat them like some mysterious black box. The whole point is that they're a transparent wrapper. You can, and you absolutely should, look inside that wrapper to make sure the stuff it holds actually lines up with what you're trying to do with your money. And that brings us to the big challenge we face today. Because ETFs have been so successful, there's been an absolute explosion of choice. Right now, there are over 13,000 different ETFs out there in the world, tracking everything you can possibly imagine, from the whole global stock market down to the most ridiculously specific niche industries. So I want to leave you with this final thought. The ETF revolution made low-cost, diversified investing available to pretty much everyone. It solved the problem of access. But in doing that, it might have created a totally new problem. With a universe of over 13,000 funds to pick from, maybe the hardest part of investing today isn't just getting in the game anymore, but navigating the overwhelming paradox of choice.